Hello, and welcome to Credit Compass, your guide to navigating European credit markets. This week, I will walk you through how we're thinking about the European and UK credit landscape as we move through the second quarter of 2026, and as outlined in greater detail in our quarterly published Forward Look. We will also explore the use of European credit markets by technology companies with a large deal from one of the Magnificent Seven in euros. All right, let's dig in. Each quarter, Van Hesser and myself publish our views on what we're watching in the upcoming quarter from a macro perspective. Van on the US and my views on Europe. At the highest level, the big takeaway is that Europe's long anticipated growth recovery has been delayed. And the main reason, of course, for that delay is a geopolitical shock stemming from the Iran conflict and the disruption around the Strait of Hormuz. Now, this isn't a repeat of 2022. The dynamics are different from the Russia-Ukraine crisis. Back then, Europe was coming out of a strong post-pandemic expansion and then got hit with a very concentrated energy shock. This time, the shock is broader. It's not just about gas and electricity. It's affecting a wider basket of goods. And Europe is entering this phase from a weaker growth starting point. When growth is already fragile, it becomes much harder for businesses to pass higher input costs through to consumers. And that's where the risk of stagflation starts to come into focus, slowing growth on one side and persistent inflation on the other. You can already see the early signs of that tension building. Inflation expectations have picked up meaningfully. Households and businesses alike are now anticipating inflation running at around 4% over the next year. At the same time, input costs are rising across multiple sectors, and producer prices have been moving higher. The key question is whether this remains a temporary shock or whether it starts to embed itself more structurally into the economy. Central banks are going to have a much more difficult balancing act to contend with. Now, alongside that inflation story, sentiment has been taking a noticeable hit. Consumers in particular are feeling the pressure. They're dealing with higher fuel costs, elevated mortgage rates, and still sticky food prices, all while being bombarded with headlines about geopolitical instability and even concerns about job security tied to the adoption of artificial intelligence. Unsurprisingly, confidence has dropped off most major European economies and quite sharply in the UK. Businesses are a bit more resilient, but even there, the tone is softened. Survey data and PMIs are pointing to a more cautious outlook, and when sentiment weakens like this, it doesn't just stay in the surveys, it feeds through into real economic behavior. People spend less, companies delay investment, and that's where you start to see the risk of demand destruction, which can further weigh on growth. Of course, there are also clear headwinds. The supply disruptions tied to the conflict are pushing up costs and in some cases limiting availability of key inputs. At the same time, weaker demand makes it harder for companies to pass those costs on, which puts pressure on margins. You've also got a stronger euro weighing on export competitiveness and structural challenges in key economies like Germany. Add to that increasing competition from China, and it's a fairly complex operating environment for European corporates. That said, it's not all negative. There are some meaningful tailwinds supporting the credit environment. One of the most important is ongoing capital expenditure. We're seeing continued investment in infrastructure, defense, and technology, and while these don't translate into immediate growth, they do build a foundation for future expansion. There's also been a policy shift in Europe towards improving competitiveness. Progress has been gradual, but a large number of reforms are now in motion. From a market perspective, higher yields are also supportive to investor interest. As benchmark rates have moved up in response to inflation concerns, the all-in cash yield available in credit markets has become more attractive. That's important because even though spreads are still relatively tight, those higher yields are drawing in investor demand and helping to support issuance and spreads. Fiscal constraints are another important piece of the puzzle. Many governments are already carrying high levels of debt, which limits their ability to step in with support measures. And as inflation pushes interest rate expectations higher, borrowing costs are rising across the board. So the capacity to respond is more limited than it might have been in the past. One of the more interesting dynamics we're watching right now is the divergence between manufacturing and services. Manufacturing indicators are starting to show early signs of improvement. It's tentative, but it suggests we may be entering a restocking phase, potentially supported by increased defense and infrastructure spending. In contrast, services, which have been the backbone of employment and stability, are starting to soften. Higher prices, weaker confidence, and tighter financial conditions all weigh on the prospects for discretionary spending. That divergence creates a bit of a mixed signal for the broader economy. On one hand, you've got parts of the industrial sector beginning to stabilize. On the other, the consumer facing side of the economy is losing momentum. How that balance evolves will be critical in determining the growth trajectory from here. And all of that is dependent upon the duration of the conflict in the Strait of Hormuz and the ability for companies and countries to adapt to the current constraints. So, where does that leave us? Broadly speaking, Europe is in a challenging spot. The geopolitical shock has introduced a more persistent and widespread inflation dynamic, while also undermining confidence and delaying the growth recovery. The risk of stagflation is real, particularly if the current disruption persists. But at the same time, there are underlying supports in place, particularly in the form of investment and early signs of a manufacturing upturn that could help cushion the downside. The key question is timing. When does growth reaccelerate, and how long does inflation remain elevated? For now, the balance of risks suggests a slower path forward than previously expected. The recovery isn't off the table, but it's likely been pushed further out, potentially into the second half of the year or even beyond. Now, on the AI front, capital expenditure continues, and Alphabet has chosen to approach Europe this go around in raising funding. The company came to market on Tuesday, raising 9 billion in euro-denominated debt, their largest ever in euros, while also launching a multi-tranche deal in Canadian dollars. And this comes just months after raising roughly $32 billion across other markets. It was issued in 6 tranches, ranging from 4 years to 37 years, and came amidst a busy European pipeline with a total volume of 23 billion euros issued on the day, more than all of the prior week's issuance combined. When the window opens, there is a scramble to capitalize. The funding needs tied to AI are enormous. Alphabet alone is planning up to $190 billion in capital expenditures this year, largely for data centers and infrastructure. And across the broader hyperscaler group, think Oracle, Microsoft, Amazon, Meta, we're looking at something over $700 billion in total spending. These companies are now treating global bond markets as a core funding engine. They're issuing across currencies, across maturities, and across investor bases with a level of sophistication and frequency we typically associate with sovereigns or large financials. Demand is still strong for now. Alphabet's Euro deal reportedly drew more than 25 billion in orders, which tells you there's still deep appetite for high-quality credit. But at the same time, we're starting to see some cracks. The volume of issuance is simply very large, and investors are beginning to demand more compensation to absorb it. You see that in wider spreads, higher new issuance concessions, and slightly softer order books in some recent deals. So, while the credit fundamentals remain strong, Alphabet is still firmly investment grade, there's growing sensitivity around valuation and supply. And that brings us to the key tension. This isn't about near-term credit risk, it's about uncertainty around returns. These companies are investing at an unprecedented pace in AI, but the monetization path isn't fully proven. So investors are starting to ask, are we being paid enough for that uncertainty? For many, the answer is increasingly yes. Higher yields and wider spreads are creating opportunities to pick up incremental return without moving into lower quality credits. Stepping back, the bigger picture is that big tech is becoming a dominant force in credit markets, just as it already is in equities. And as long as AI spending continues at this scale, they're going to remain a major driver of supply, pricing, and investor focus. So where does that leave markets? Well, when we turn to valuations, the picture overall is nuanced. Credit spreads are wider slightly this year, but they remain tight relative to historical averages. That reflects the fact that corporate fundamentals are still relatively strong and default rates remain low. However, yields have moved higher quite significantly, driven by rising benchmark rates, and that's shifted the relative value equation. In fact, we're now in a situation where high-yield bonds are exceeding equity earnings yields, and corporate bond yields are higher than dividend yields. That makes credit look increasingly attractive on a relative basis. For investors, that higher income component can help compensate for some of the macro uncertainty. And in that environment, credit markets are likely to remain supported by yields, but increasingly sensitive to any signs of deterioration in growth or corporate performance. That's all for this week's edition of Credit Compass. If you found today's discussion insightful, please follow, rate, and share the show. It helps others to discover it. For deeper insights and, of course, our quarterly forward look and data-driven analysis on macro and credit trends, please visit kbra.com/macrocredit. Till next time, stay curious, stay informed, and stay resilient. Let Credit Compass guide your way.